Hi there. Okay, so you're considering annuities. Guaranteed income and peace of mind in retirement is an exciting goal. And believe it or not, it's easily attainable. Stick with me for a few minutes because by the end of this video, you're going to learn more about annuities than you thought possible and find out if they're the right solution for you. That sound good? After helping thousands of people plan their ideal retirement, reach their financial goals, and put their retirement income on autopilot, it's become pretty clear why Americans put over $360 billion into annuities last year. I get asked questions like these all the time. I'm retiring soon. What should I do with my 401k? Should I look at fixed annuities or indexed annuities? What are the potential downfalls with an annuity? Before I talk about the types of annuities, I want to discuss why annuities are even a thing. If you're like most of our clients, you've done your best to put every extra dollar you could into your retirement savings, with the goal being to accumulate enough wealth to do the things you want to do once you're done working. Maybe that's spending time with loved ones and grandkids. Maybe that's traveling the world or picking up a new hobby or skill. We hear it all the time from clients. The older they get, the less they want to worry about money. They just want to know that the income to fund the retirement they want is going to be there. But the reality is, as you get closer to retirement, you have less time to recover from potential market downturns. Think about this. If you are 20 years away from retirement and the market goes down 10% this year, you have 19 years to recover. But if you're retiring in the next 1, 2, or 5 years, or currently taking income that's exposed to the market, you don't have the luxury of time on your side. When you withdraw assets while the market is down, your losses on those assets are locked in. Unlike the accumulation phase, that money no longer has the potential to increase if the market rises. That loss will diminish the total value of your remaining assets. Over time, the chipping away of assets can cause your money to run out quicker than anticipated. This is called sequence of returns risk. Let me give you an example. Let's say you're retiring with a $1 million nest egg and plan to withdraw 5% per year, so $50,000. Let's also assume a 3.5% annual adjustment for inflation. Assuming that today's market volatility will continue, meaning you'll get both positive returns some years and negative returns other years, let's find out how long your nest egg would last under two market scenarios. The first scenario is that you start taking income when the market is up. We're going to follow a repeating pattern: 27% growth, then 9% growth, 7% growth, and then a 15% loss. When you start withdrawing income with 27% growth in the first year, your nest egg is on track to last you 36 years. But what if you start withdrawing income in a down market? Let's take a look at the second scenario. Say the first year you withdrew was the 15% loss and it followed the same order of returns: 27% growth, then 9% growth, followed by a 7% growth. In this scenario, your money would only last you about 23 years. That's 13 years less than the first scenario simply because you started withdrawing money in a down market. As we both know, there's no way to predict what is going to happen and how much the market will be up or down when you start retirement. Now you can see why annuities exist and why they are so popular. They protect the downside from market losses while still allowing you to participate in market gains and fixed interest rates. They help reduce the risk that your retirement will look different than what you had envisioned. Now that we've covered their purpose, let's dig into how they work. Annuities primarily have two phases: accumulation and income. The accumulation phase is the period when your account is growing and being credited a fixed interest rate or percentage of the market's gains. The longer your account grows, the higher balance you're going to have at the end, and the more income you'll generate from that account. The other key aspect of this accumulation phase is that the credited interest is tax deferred until you actually withdraw the money from the annuity, meaning your money will grow faster than in a bank or CD. The second phase is the income or distribution phase, which is exactly what it sounds like. You're taking income. Let's take a look at some examples from some recent clients. We recently had a client who is 60 years old and had $200,000 in a 401k. He wanted to convert that account balance into a stream of lifetime income that he will never outlive. We were able to help him turn that $200,000 into more than $25,000 in guaranteed income per year for life when he retires in 5 years. We also recently helped a client who had purchased an annuity several years ago that was producing income. The client's agent didn't keep them updated on rate changes, and we were able to replace his existing annuity with an A+ rated carrier that paid $6,000 more per year than his current annuity. Now, why are annuities provided by insurance companies? Because they're incredibly stable financial institutions. Since 2001, there have been 567 bank failures. Compare that to the 31 insurance companies over the same time period. I do want to specifically point out that we only work with top-rated insurance carriers. And for our higher net worth clients, we recommend diversifying across multiple carriers to eliminate concentration risk. If you're watching this and think that an annuity may be right for you, let's jump into some tips and get you on the right path right now. Know your goals. When do you plan on taking income from the annuity? Are you looking at annuities more for asset accumulation or asset distribution? These are important things to know that will influence the type of annuity and specific product. Focus on highly rated carriers. The main rating agency for insurance carriers is AM Best. Make sure to get access to these ratings to ensure you're purchasing from a quality insurance carrier. If you work with our team, we provide these company ratings to all of our clients. Don't forget about servicing. After you purchase an annuity, you'll want to make sure you're working with someone who is going to monitor for your rate changes to see if there are any opportunities to get into a higher yielding product. So now that we've hit on the basics, I invite you to schedule a complimentary meeting with our team. On our first call, we're going to learn more about your goals and objectives to make sure that we're putting together the right options. We'll provide you with an easy-to-digest online comparison report along with our recommendations so you can easily see how much account growth and income you can get with an annuity. We'll take time to answer any and all questions you have to ensure you're making the best decision for yourself and your family. If you decide to move forward with us, we'll work together to fill out the application and get your annuity activated. After activation, our proprietary software will monitor your annuity in real time to make sure you're still getting the best rate as the market conditions change. This means each month you'll know whether or not you still have the best income and account growth options that are available to you. My name is Summer, and I cannot wait for you to take action to achieve the peace and retirement that you deserve. Please find a time on the calendar next to this video that is convenient for you so we can find out if an annuity is right for you. Thanks for your time.